Hi, this is Raj Sukheja, your deal and business architect, bringing you a new video today on your request. Today, we're talking about something uncomfortable but absolutely necessary in business. Value for value. No free lunches in professional advisory, no complimentary strategy sessions for serious capital decisions, no casual extraction of intellectual capital. Let's approach this with logic. Every business decision sits on three pillars: capital, structure, risk. Capital is visible, structure is technical, risk is often invisible. Professional advisory operates at the intersection of structure and risk, and that is precisely why it is undervalued. Because you cannot visually measure a disaster that never happened. Let's talk numbers. A poorly structured equity raise can dilute founders by 25 to 40%. A mispriced debt instrument can increase effective borrowing by 1 to 3% annually. A weak shareholder agreement can destroy control rights permanently. Now compare that with an advisory fee of 3 to 5% on a transaction. If a $10 million raise is structured properly and saves 10% dilution, that is $1 million in retained equity value. Over a 5-7 year growth horizon, that retained equity could be worth exponentially more. And yet many promoters hesitate to pay for the architecture that provides that upside. Why? Because advisory is intangible. You see the invoice, you don't see the avoided catastrophe. Professional advisory is not information, it is judgment under uncertainty. Information is everywhere, judgment is earned. When we evaluate a transaction at Red Mammoth Ventures LLP, Global Deal Architects and Advisory, we are not simply introducing investors. We evaluate term sheet asymmetry, liquidation preferences, board control clauses, covenants and personal guarantees, cross-border compliance check, exit alignment, capital stack layering. That is structural engineering of finance. You wouldn't ask a structural engineer to just quickly review a building design before construction, because if the foundation fails, everything collapses. Deal architecture is financial foundation design. Now let's discuss behavioral economics. There is a psychological bias called zero price effect. People intentionally, irrationally overvalue anything that is free. But free advice carries no obligation, no depth, and no accountability. Paid engagement changes behavior on both sides. When there is contractual engagement, scope is defined, timelines are respected, information is disclosed properly, confidentiality is formalized. Responsibility is mutual. Free consulting creates optionality. Professional engagement creates commitment. Serious markets understand this. In mature financial ecosystems, retainers are standard. Advisory mandates are signed before work begins. Strategy is not distributed casually. Why? Because intellectual capital is an asset class. Let's shift perspective. You invest in machinery, you invest in marketing, you invest in talent. Why do some hesitate to invest in risk mitigation and capital structuring? Because the return is not always immediate, but it is protective. And protection is not glamorous, it is strategic. Value for value is not about ego, it is about alignment. When one party invests years of experience, networks, transaction exposure, and reputational capital, there must be corresponding seriousness from the other side. Otherwise, the equation collapses. At Red Mammoth Ventures, we believe in structured engagement. We identify investors, we structure hybrid instruments, we design transaction flow sheets, we evaluate cash flow alignment, we protect promoter interests, we ensure downside is modeled before upside is marketed. That requires discipline, and discipline requires value exchange. If you're building a serious enterprise, surround yourself with serious advisors. Define scope, agree on fees, engage properly. But in capital markets, structure decides survival, and the survival precedes scale. Ask yourself today, do you treat advisory as a cost or as strategic insurance? That mindset shift determines whether you operate transactionally or architecturally. Business is not built on free advice, it is built on aligned incentives. Value for value, respect for expertise, commitment for commitment. If you like this video, subscribe, comment, and like so that we can continue to bring such videos to you. No fluff, no noise, straight facts and analysis of the business topic and how I see it. All those who comment seminar will be offered one complimentary online seminar shortly. Thank you. This is Raj Sukheja, your host, signing out.